미국 연준이 5월 FOMC에서 기준금리 빅스텝 인상을 예고하고 나섰는데요. 연내에는 이보다 더 높은 0.75%포인트 인상하는 자이언트 스텝 가능성까지 거론되고 있습니다. 미국의 기준금리 인상이 본격화하면서 투자자들도 더 이상 안심할 수 없는 상황이 됐는데요. 미국의 금리 인상은 얼마나 될지, 또 미국의 금리 인상이 우리나라에 미치는 영향은 어느 정도일지, 또 금리 인상기의 매력적인 투자처는 어디일지, 이런 질문에 대한 답을 얻기 위해서 저희는 전 연준 위원이었던 윌리엄 더들리 전 뉴욕 연은총재를 직접 만나서 그의 이야기를 들어봤습니다. This morning in Seoul, we are delighted to have Global Guru with us. He is a former New York Fed president and also Princeton University senior research scholar. Please welcome Mr. William Dudley. Nice to see you. Thank you for joining us today.
Great to be here.
How do you expect that the Fed big step to be developed, and what is the expected base rate for the end of this year?
Well, obviously, nobody knows for sure because it depends on how the economy evolves and how markets react to the Fed's tightening. But I think the Fed is a very strong mind right now to move rates up pretty sharply over the next 6 months, probably to around 2.5%. That's a pretty close estimate of what they see as neutral, a monetary policy that's neither easy or tight. And because the labor market in the United States is very tight and inflation is quite high, they want to get to neutral very quickly. So it takes some unusual events from here to push them off that path.
You predicted that the recession is inevitable due to Fed efforts to control inflation and will occur in 2023 or 2024. You also warned that if a recession does not occur, it puts the U.S. economy at greater risk. Fed President James Bullard said a recession is premature. He explained that the Fed will try to catch inflation without a recession. What are your thoughts on this? What amount of recession would concern you?
Well, of course, the Fed's going to try to avoid a recession. The problem, though, is that when the Fed has found themselves in the current circumstance that we are today, with a labor market that's too tight, the Fed has never been able to tighten monetary policy, push up the unemployment rate, and not have a recession. Chair Powell, in his comments recently, talked about 3 episodes where the Federal Reserve tightened monetary policy and a recession was avoided: 1965-66, 1984-85, and 1994-95. The problem is none of those episodes are relevant to the current set of circumstances. In all 3 of those cases, the unemployment rate continued to decline. The unemployment in the U.S. is already 3.6%, below where the Fed thinks full employment is. So the Federal Reserve has to tighten monetary policy enough to slow the economy down so the unemployment rate moves up. The problem is whenever the unemployment rate moves up more than marginally, the next stop is a full-blown recession. There's never been a set of circumstances in the U.S. since World War II where the unemployment rate went up 0.5% and stopped, 1% and stopped, or 1.5% and stopped. It's either small, trivial rises or a full-blown recession. Now, I agree with Jim Bullard that recession is not likely in the near term. The economy has considerable forward momentum. Household balance sheets are in excellent shape. There's a lot of demand that has not been satisfied recently because of the supply disruptions. So, for example, in the motor vehicle sector, the demand exceeds supply. And so even if the Fed restrains supply a bit, demand a bit, you're still going to see increases in output as supply chains normalize. The key issue here is not the headline rate of inflation. The headline rate of inflation is going to come down over the next year as some of the transitory factors like big increases in used car prices reverse. The problem is the labor market's too tight. Chair Powell even called it unhealthy degree of tightness, which is a hard thing for Fed officials to say because talking about too many people being unemployed is not something that the Federal Reserve wants to sort of admit to or underscore. The problem is that the Fed tightened monetary policy too late. And because they responded too slowly, the labor market got to a point where it was sufficiently tight that it's likely to put further upward pressure on wages And that's the thing that's going to drive ongoing inflation.
You have been warning bondholders since early last year. As you'd expected, U.S. bondholders posted their biggest losses in 42 years in the first quarter of this year. Following the Fed rate increase, how should bond investors react at this point?
Well, I think the bond market, has now finally priced in the fact that the Federal Reserve is going to a neutral monetary policy. But I don't think the bond market is fully priced in the fact that the Federal Reserve is likely to have to make monetary policy tight. The current Federal Reserve forecast from March basically shows a very benign kind of outcome. The Federal Reserve moves the federal funds rate up to slightly above 2.5%. The economy slows, inflation falls, and we avoid a recession. I think the Federal Reserve is going to have to do more because they're going to need to make monetary policy tight. And if inflation turns out to be higher than 2%, which is their target, a neutral monetary policy rate is not 2.5%, it's something higher than that. So I think the bond market is, the correction is appropriate, probably still has a little bit farther to go.
Mike Wilson, CIO of Morgan Stanley, warned of sluggish earnings, saying given the numerous cost pressure facing businesses, the earning outlook for this year is too optimistic. Do you think inflationary pressure will backfire on corporate earning growth? Morgan Stanley also predicted that the S&P 500 could drop to 4,000 this year. Will the stock market turn downward this year?
In terms of the earnings outlook for U.S. corporates, I think it's still okay because the economy still has a considerable forward momentum, and in a lot of sectors, the demand exceeds supply. That said, we are in a economic environment now where there's a shortage of labor, so that limits how fast the economy can grow. Number one. Number two, when labor is in short supply, usually what happens is profit margins get squeezed as businesses are forced to compete for that scarce labor. So I think we're certainly going to see a significant slowdown in earnings growth in the year ahead. In terms of the stock market, I think the stock market is probably going to struggle. Number one, earnings growth is going to slow. Number two, the Fed is tightening monetary policy. And number three, the risk of recession, not this year, but in 23 and 24 is increasing. I think all those things are going to weigh on the stock market. The Chair Powell was very clear to market participants not too long ago. He said financial conditions have to be tightened. That's how monetary policy works. It works through financial conditions. Well, what makes up financial conditions? The bond market, the stock market, the dollar, the valuation of the dollar. And so we're probably going to see some combination of those three things: higher bond yields, weaker stock prices, firmer dollar. And so far, all three things are playing out. So the good news from the Fed's perspective is they're finally getting a little bit of traction. They wanted to tighten financial conditions. They're now managing to do that to some degree. And so that's good because that means the monetary policy shift is starting to have consequences.
More and more Koreans are investing in U.S. stocks. They especially love tech stocks like Tesla. Will the high recorded by U.S. tech stock at the end of last year ever come again?
Well, all records are broken at some point. I think the big problem for the high growth sector at this point is just that there's more competition from the bond market. So if you look at 10-year Treasury invested protected securities, inflation protected securities, the real yield on those was minus 1% a few months ago. Now it's close to zero. So as real interest rates rise, that puts more pressure on growth stocks, where you're putting a lot of value on future earnings, years into the future. So I think it's really the rise in real rates that's weighing on the high growth companies.
In this low growth era, which sectors should be noted as industries that are strong in crisis?
Well, I think that, we're late cycle. So you want to start to think about areas of the stock market that are less cyclical. So consumer non-durables, for example, healthcare, for example, things that people are going to buy regardless, whether times are good or whether times are bad. And I think you have seen a rotation out of growth stocks towards these kind of sectors. So that's, a little bit more defensive posture in terms of equity investing is probably warranted now. We've been used to these very long business expansions in the United States, 1990 to 2000, 2001 to 2008, 2009 to 2020. But this is going to be a pretty short business cycle because the last cycle was just interrupted by the COVID pandemic. So we're in a situation like we are, within a year or two of the end of the business cycle, not like at the beginning of the business cycle.
Among Wall Street experts, opinions are divided as to whether the U.S. stock market will stable this year. Should investors turn their eyes to emerging market? What is your opinion?
Well, I think, the problem for emerging markets, I think this year is really going to be the fact that interest rates in the U.S. are rising. And as interest rates in the U.S. rise, that can lead to capital flow reversals out of lower and moderate income countries back to the U.S. So there could be some pressure on the capital accounts of some emerging market economies. Also, we have this huge wild card about what's happening in China with the COVID pandemic and the shutdowns in China. That can obviously have some significant consequences for demand from China, which is obviously a very large economy, and also can generate weakness in commodity prices. So I think how China copes with the pandemic over the next 6 to 12 months is also going to be important for emerging market economies.
As global interest rate hikes begin in earnest, some countries such as Sri Lanka are experiencing a shock. Is there any possibility that such a steep hike could lead to a global debt crisis?
I think that we are going to have a lot of problems in the sovereign debt market in the near term because interest rates are going to be higher, so the money is going to want to flow out of these countries. The U.S. recovery has led, and the recovery in a lot of these poor countries has lagged, partly because the vaccines have not been as available in those countries as early, and also because they're being hit by shocks from what's happening in China. So I do think that sovereign debt difficulties are highly likely in the next 12 to 24 months.
The Japanese yen has fallen to its lowest level in 20 years. What do you think of the opinion that the position of the yen as a traditional safe asset is shaking?
Well, I think the yen is weakening more because the U.S. economy is strong and the Federal Reserve is tightening. I think, if you look at Japan, inflation is much lower. There's much less pressure on wages. The Japanese are still trying very hard to, get back to their inflation objective. They've fallen short of their inflation objective now for, 20 years or so. So they don't have an inflation expectations problem. They don't have an inflation problem. So they're very far away from beginning to tighten monetary policy. In contrast, the Fed is tightening monetary policy now quite quickly. And so it's that widening of interest rate differentials, I think, that's really contributing to the strength of the dollar and the weakness of the yen. I don't think it's a problem with, Japanese economy fundamentals. I think it's just where these two countries are relative to, in the business cycle and where they are relative to inflation and interest rates.
An increasing number of American companies are adopting Bitcoin cryptocurrencies as a payment method. As a former Fed member, what are your views on the future of cryptocurrencies?
Well, I think I'm the chair of the Bretton Woods Committee, and we just put out our first paper on digital finance. We think that digital finance has a lot of potential because there's a number of use cases internationally where digital finance could come up with better solutions. The blockchain technology seems to have real promise. International payments, digital identity, securities settlement. We think there's a lot of areas where digital finance could actually contribute quite well. But right now, there aren't appropriate regulatory guardrails to protect people, protect consumers, protect investors. That'd be the first thing I would say. The second thing I would say is, I think you really want to distinguish between crypto assets, which at times is very speculative activity relative to the promise of the technology, distributed ledger technology. We think the technology has quite a bit of promise. We worry that there's a lot of froth in terms of people's, support for individual crypto assets. I look at Bitcoin, for example. Bitcoin, not a stable store of value. not a good medium of payment. It's costly and it's slow. I think there's better medium for payments than Bitcoin. And I think what will happen with Bitcoin is eventually there'll be a better crypto asset than Bitcoin, and then when that happens, people will move towards that crypto asset.
What advice would you give to an investment portfolio for individual investors?
Well, the first thing I would say is you need to invest for the long term. So make your investments, put it away, and don't react to near-term news. If you had sold everything in 2008, 2009, you would have missed a big recovery in the stock market subsequent to that. The best thing to do is stay invested. The best thing is to rebalance. When the stock market goes up a lot, take a few chips off the table. Rebalance your portfolio. And lastly, don't chase fads. Don't chase fads. There's always a hot part of the market that people get attracted to. The problem for the average investor, though, they enter that hot area late rather than early. And so usually when the bubble bursts, and we're sort of seeing a little bit of that bubble bursting in the U.S. tech sector right now, they don't get all the gains, but they get all the losses. But the big thing is to be a long-term investor with a balanced portfolio. If you do that, my own personal investing strategy is to hold broad-based ETFs and just hold them as a core part of my portfolio, and don't worry about it when the stock market goes up or down. And occasionally rebalance.
I think we cover a lot. Thanks once again for sharing your insight with us.
Okay, well, thank you very much. It's been a pleasure.
미 연준의 기준금리 인상 시나리오와 함께 금리 인상이 주식시장을 비롯한 전 세계 경제에 미칠 영향을 살펴봤습니다. 가파른 금리 인상 가능성이 공식화한 만큼 투자자들도 투자 전략을 다각도로 고민해야 할 때인 것 같습니다. 시청해주신 여러분 고맙습니다.